Right now, investors are watching the Federal Reserve closely. Why? Because weak job numbers have raised the odds of rate cuts ahead. And when rates fall, income investors go hunting for yield. That's where SEHD comes in. It's paying just over 4%, a rare level for this fund. In fact, this has happened only twice since its launch in 2011. The last time, buying SEHD turned into one of the best opportunities in years. So could this time be the same? That's what we're going to explore, from the Fed's policies to SEHD's dividend track record and the risks too. But remember, this is not advice, it's education. And I'll say something many won't agree with. If the Fed really cuts aggressively, cash savings accounts may end up being the worst place to park money. Chapter 1. Setting the Macro Backdrop. Fed Cuts and the Search for Yield. Let's start with the bigger picture. Right now, all eyes are on the Federal Reserve. Its job is to balance two things: jobs and inflation. And the latest numbers tell an interesting story. In August 2025, the US economy added just 22,000 jobs. The forecast was for 75,000. That's a big miss. On top of that, earlier job numbers were revised lower. So the labor market is cooling. Now here's why that matters. When growth slows, the Fed often cuts rates, and future markets are already betting on it. Investors now expect multiple cuts by year end, maybe even one as soon as September. But here's the twist. Slower growth should normally hurt stocks. Yet the market went up on this weak jobs report. Why? Because investors are already thinking ahead. They see lower rates coming, and they're preparing for the search for yield. What does that mean? It means when rates drop, safe options like savings accounts, CDs, and treasuries pay less. So, income investors start looking for better returns. They move into dividend stocks and funds. That new demand can drive prices up. We've seen this before. In past easing cycles, bonds did well during the cuts. But equities, especially dividend-paying ones, shined once the cycle was over. So here's the key point. If the Fed really does cut, the search for yield will intensify. And that creates a setup where dividend-focused funds like SEHD may attract fresh interest. Chapter 2. SEHD at a glance. What it really is. Now let's talk about SEHD itself. This isn't some brand new product. It launched back in October 2011, and today it manages around $71.9 billion in assets. That's a serious scale. One of the biggest selling points? Its cost. The expense ratio is just 0.06%. That means almost all of your return stays in your pocket. But what really makes SEHD unique is its strategy. It tracks the Dow Jones US Dividend 100 Index. That's a rules-based system. No human manager picking favorites. Instead, it screens companies using 4 filters. First, a solid 5-year dividend growth rate. Second, strong cash flow to debt levels. Third, good return on equity. And fourth, an attractive forward dividend yield. In plain terms, SEHD only takes companies with strong finances and reliable dividend histories. It skips the weak links. And yes, that often means skipping flashy growth stocks. So, what does the portfolio look like? It leans defensive. Top sectors include energy at 19.9%, consumer defensive at 19.1%, and healthcare at 15.9%. Like Chevron, PepsiCo, AbbVie, Home Depot. This focus makes SEHD different from the S&P 500. It isn't chasing tech rallies. It's built more like a safety net. Slow, steady, income-focused. And that design is exactly why investors turn to it in uncertain times. Chapter 3. The 4% Yield Milestone. Why it's so rare. Now here's the part that gets people talking. SEHD is paying a yield above 4%. That might sound ordinary. Lots of funds pay more. But for SEHD, this is a big deal. Why? Because it almost never happens. Since its launch in 2011, SEHD has averaged about 2.9% yield. For years, investors were buying it closer to 2 or 3%. In fact, SEHD has crossed 4% only twice in its entire history. Once in 2020, at the height of the pandemic, and now again in 2025. Back in 2020, when prices crashed and yield spiked, SEHD offered more than 4%. Investors who bought then ended up with some of the fund's strongest returns ever. It turned into one of those rare windows of opportunity. And here's another stat. Across over 3,300 trading days, SEHD has only offered a 4% yield about 25 times. That's less than 1% of the time. So what does that tell us? It says this level is unusual. And history shows unusual yields often come with unusual opportunities. Now, of course, nothing is guaranteed. A high yield today doesn't mean automatic success tomorrow. But it does raise an interesting question. Is today's SEHD yield flashing the same signal it did in 2020? Chapter 4. Total Return and Risk Profile. SEHD versus S&P 500. Let's zoom out and compare SEHD to the market. The easy benchmark is the S&P 500. So how has SEHD really stacked up? Since inception, SEHD has delivered about a 9.8% annualized return. The S&P 500, closer to 14.7%. That's a big gap. And it's why some people dismiss dividend funds. But that's only half the story, because returns are one thing, risk is another. SEHD's volatility has been much lower. Its standard deviation sits around 11.5%. The S&P 500 is about 14.1%. So SEHD moves less, swings less, and feels steadier. What about the worst case scenarios? SEHD's maximum drawdown has been negative 23.6%. The S&P 500's negative 23.9%. Pretty close, but SEHD still edges out slightly. In plain language, SEHD hasn't been designed to beat the market in raging bull runs. It's designed to give you a smoother ride. Less excitement, less drama, and steady income on top. So the trade-off is clear. You give up some upside in boom times, but you get ballast when the market turns choppy. And for investors looking for income and stability, especially during Fed cuts, that trade-off might be worth it. Chapter 5. Dividend Growth. Why SEHD isn't just fixed income. There's a common myth about dividend investing. People think dividends are fixed, like bond coupons. But SEHD proves that's not the case. Unlike bonds, which pay the same interest year after year, SEHD's payouts have grown. And they've grown a lot. Let's look at the numbers. In 2012, SEHD's annual dividend was just 59 cents per share. By 2024, it had climbed to about $1.53. That's more than doubling in just over a decade. And the average growth rate? Around 10% per year. Between 2013 and 2024, SEHD's dividend growth was even stronger, about 11.6% annually. That's powerful compounding, because it means your income stream isn't just steady, it's expanding. And that's a key difference compared to fixed income options. If you buy a treasury bond, your coupon is locked. If inflation rises, your real income loses value. But with SEHD, dividend growth can act as an inflation hedge. This is why long-term investors love funds like this. They're not just collecting today's yield. They're watching that yield on cost climb higher over time. So when people ask, why not just park money in bonds or CDs? The answer is simple. Bonds pay you once. SEHD has the potential to pay you more and more each year. Chapter 6. SEHD versus income alternatives in a Fed cut world. Now let's put SEHD side by side with other income choices, because when the Fed cuts rates, comparisons matter. Right now, many investors are sitting in high-yield savings accounts or in CDs and treasuries. Yields there have been around 4 to 5% recently. Pretty attractive, right? But here's the catch. Those yields won't last. As soon as the Fed cuts, they fall. Your savings accounts that pay 5% today might pay only 2% tomorrow. CDs and treasuries are fixed, so if you lock in, you're stuck with that rate until maturity. SEHD is different. Its current yield is about 4%, similar to those alternatives, but it also offers growth potential. Dividends have historically increased, while bank interest does not. There's also tax treatment. SEHD's qualified dividends are often taxed at lower rates. Savings account interest, taxed at regular income. Same for CDs and treasuries. Of course, SEHD comes with market risk. Your account balance can swing, while cash accounts are FDIC insured and safe. So the trade-off is clear. If you want guaranteed stability, cash and treasuries win. But if you want an income stream that might rise with time, SEHD becomes more attractive, especially in a world where rates are falling. That's why some argue that in the next rate cut cycle, SEHD's 4% yield may shine brighter than a savings account ever could. Chapter 7. Risks and what could go wrong. So far, SEHD sounds like a solid setup, but let's be clear, it's not risk-free. First, the Fed itself. Everyone is expecting cuts. But remember, the Fed is data dependent. If inflation flares up again, cuts could be delayed or even reversed. And without those cuts, the search for yield narrative may not play out the same way. Second, sector concentration. SEHD leans heavily into energy, consumer defensive, and healthcare. These sectors are considered defensive, yes, but they're not bulletproof. If oil prices crash or healthcare regulation shifts, those weights could hurt. Third, dividend risk. Even with SEHD's strict screens, companies can cut dividends in hard times. It's rare for high-quality firms, but it can happen. And when it does, it can drag down the fund's income stream. Then there's market risk. SEHD is still an equity fund. Prices will fall in a broad market downturn. The dividends help cushion the blow, but they don't erase it. Finally, valuation. SEHD trades at a PE around 15, cheaper than the S&P 500. That looks attractive today, but if markets correct broadly, even fair valuations won't protect you from price declines. So, SEHD offers strong potential, but like every investment, it comes with trade-offs. That's why it should be part of a diversified portfolio, not the whole plan. Chapter 8. Closing and key takeaways. So let's wrap it up. SEHD at a 4% yield is rare. It's happened only twice in its history, and the last time it turned out to be one of the best buying opportunities. With the Fed likely cutting rates, the search for yield will intensify. Cash yields will fall. Fixed income will flatten. But SEHD offers something different, an income stream with room to grow. Still, it's not a sure thing. There are risks. Market swings, sector exposure, and Fed uncertainty all matter. But for investors who want long-term income with stability, SEHD deserves a serious look. And maybe here's the real question to debate. In a falling rate world, is boring SEHD actually the most exciting play?